Hello, everyone. Today we are going to learn International Financial Management, Chapter 2. The learning objective for Chapter 2 include 1. Explain the key components of the balance of payment. 2. Explain the growth in international trade activity over time. 3. Explain how international trade flows are influenced by economic and other factors. 4. Explain how international capital flows are influenced by country characteristics. 5. Introduce the agencies that facilitate the international flow of funds. The balance of payment is the summary of transactions between domestic and foreign residents for a specific country over a specified period of time. The components of balance of payment statement include current account, capital account, and financial account. The events that increased trade volume, including removal of the Berlin Wall, Single European Act of 1987, NAFTA, General Agreement on Tariffs and Trade, the European Union, inception of Euro, and other trade agreements. So what is outsourcing? Outsourcing is the process of subcontracting to a third party in another country to provide supplies or services that were previously produced internally. Trend in U.S. trade of balance of U.S. trade. So the quarterly trend in the U.S. balance of trade is shown in the exhibit here. There are many factors affecting international trade flow. Those factors include the cost of labor, inflation, national income, credit condition, and also government policies. The government policies include restrictions on imports, subsidies for exporters, restrictions on piracy, environmental restrictions, labor laws, business laws, tax breaks, and country trade requirement. Other government policy, including government ownership or subsidiaries, country security laws, and policies to punish country governments. Another factor is exchange rates. Exchange rate is current account decreases if currency appreciates relative to other currencies. So the J curve shows that as time goes, US trade balance will increase. At initial stage, it will getting worse. So that's what we call the J-curve effect. Next, we want to talk about the impact of the international flow of funds on US interest rate and the business environment. So as we can see, as the amount of fund increases, the demand curve will be downward sloping. The long-term interest rate has a negative relation along the demand curve relative to the amount of fund. For the supply curve, that's the opposite. So agencies that facilitate international flows include International Monetary Fund, IMF, World Bank, World Trade Organization, WTO, International Finance Corporation, and International Development Association. Other agencies include Bank for International Settlements, OECD, which is Organization for Economic Cooperation and Development, or regional development agencies. The key components of the balance of payment are the current account and the capital account. The current account is a broad measure of the country's international trade balance. The capital account measures the value of financial and non-financial assets transferred across country borders. The financial account consists mainly of payments for direct foreign investment and investment in securities or portfolio investment. International trade activity has grown over time in response to several government agreements to remove cross-border restrictions. In addition, MNCs have commonly used outsourcing in recent years, subcontracting with a third party in a foreign country for supplies or service they previously produced themselves. Thus, outsourcing is another reason for the increase in international trade activity. A country's international trade flow are affected by inflation, national income, government restrictions, and exchange rates. High labor cost, high inflation, or higher national income, low or no restrictions on imports, and a strong local currency tend to result in a strong demand for imports and a current account deficit. Although some countries attempts to correct current account deficits by reducing the value of their currencies, this strategy is not always successful. A country's international capital flows are affected by any factors that influence direct foreign investment or portfolio investment. DFI tends to occur in those countries that have no restrictions and much potential for economic growth. Portfolio investment tend to occur in those countries where taxes are not excessive, where interest rates are high, or where the local currencies are not expected to weaken. Several agencies facilitate international flow of funds by promoting international trade and finance, providing loans to enhance global economic development, settling trade disputes between countries, and promoting global business relationships between countries.